numbers for the example that I've just put on the board. So on the top, you got highlight income statement. You got sales, COGS, SG&A, depreciation expense taken out separately, interest expense, equity in earnings, income tax expense, and gain on sale of available for sale security. And this one is a realized gain. Then you have highlight balance sheet. So you got selected balance sheet account changes for the year. And I've put numberings again here. So sales on the income statement, that relates to accounts receivable on the balance sheet. So I got number 1 for increase in accounts receivable. COGS on the income statement, that relates to inventory and accounts payable on the balance sheet. So I got number 2 here. Selling expense on the income statement, which includes bad debt expense, relates to the allowance for uncollectibles on the balance sheet. So I got number 3 here. The depreciation expense on the income statement, that relates to accumulated depreciation on the balance sheet. So that's number 5. Interest expense on the income statement, that relates to bond discount on the balance sheet. So you got number 6 for decrease in bond discount. The equity in earnings of investee on the income statement, that relates to the investment account on the balance sheet. So you got number 7 for the increase in investment account. The income tax expense number on the income statement, that relates to deferred taxes and taxes payable on the balance sheet. So you got number 8 for deferred tax liability and taxes payable changes. So we have identified the income statement with the changes in accounts happening on the balance sheet. Now let's get back and solve it for the direct method first. Now using this income statement, this is accrual basis, and the changes in balance sheet accounts that we have on your example, we're going to create the statement of cash flows. And now we're looking at operating activities, and we'll do it using the direct method. Now direct method, remember I told you it's like a summary of your cash account. So the way we'll solve it is we'll try to create journal entries, look at the cash plugs there, and fit it into the summary of this cash account, operating activities, direct method. So let's look at the numbers here. Let's say number 1, we're looking at sales. Now sales has been $1,500 during the year. But has the entity collected all the $1,500 cash collections? For that, we look at the accounts receivable number on the balance sheet. Now they say that number has increased $200 from last year. What this means is maybe for all the sales that they've made, they haven't been able to collect all the cash. Of 1,500 sales they made, they could collect only $1,300. $200, it increased their accounts receivable here. Let's do the journal entry, look at the cash plug, which will get on to the cash flow statement. So I'm looking at the first journal entry that we're going to be having for sales, and it says sales have happened 1,500. Has all the cash come in? Let's look at accounts receivable, which increased by 200. Increased by 200 means a debit to accounts receivable for 200. That means cash came in only 1,300. Now this is what we were looking at. This is our cash plug, and this 1,300 would flow into the statement of cash flows. So let's have a debit and a credit here. So now the debit would be the 1,300 cash collected on sales, because it's increased the cash inflow. Yes, we are looking at it as a summary of the cash account. Moving on, the second item, COGS. The cost of goods sold is $500. Now that relates to the inventory number on your balance sheet. It also relates to the accounts payable, your vendors here. Now it says that inventory increased by $75. This went up by $75. That means we bought a lot of goods. We didn't use all that, or we didn't sell all that, but we bought more than what we sold. Accounts payable also increased by $50. What that means is we took extended credit from our suppliers or whatever. Liabilities increased. Now, let's make it very easy. Use a journal entry for all that's happening with COGS. So that's number 2. And COGS, I know, that's 500. Inventory is increased by 75. Inventory, that's a debit account. Increase means debited further. Accounts payable, that's a credit account. Increase in accounts payable, credited further. So how much has the cash actually been paid to the vendors? Because I'm not looking at what's the cost of goods sold. I'm concerned about cash gone out on the cash flow statement. So what's the cash actually used? So that's 500 plus 75. 575 minus 50, 525. And this is a number which is going to flow in to my statement of cash flows. The cash plug that we have here. Payments to vendors. Look at the third one. Selling expense. Now it says selling includes bad debt of 50. Now that's $250. Now it includes bad debts. So I would want to look at what's happening to the allowance for bad debts on the balance sheet. Allowance for uncollectibles bad debts, that's a contra accounts receivable. So you have accounts receivable less allowance for uncollectibles. So what's happening with that? Now it says that has increased by $50. So guys, selling expense includes my bad debt expense. And I'm concerned about what's happening to the allowance for uncollectibles account on the balance sheet. And using both these, let's create our journal entry. Now, so you have selling expense, that's 250. Allowance has increased. Now allowance is a credit account. It's increased, further credit, 50. How much has cash actually gone out? So though the selling expense is 250, it seems that the cash gone out is only 200. And that is the cash plug. Something we're concerned about when we're looking at the statement of cash flows. Now next journal entry, G&A expense, $100 here. Now there's nothing related to G&A that I could find on the balance sheet items. So I would say all this 100 G&A is paid out by cash. There's no outstanding, no excess payment, no deferral. G&A cash, 100. So that's my cash plug. This is the number which flows in here. Looking at the next item, depreciation. Guys, depreciation. Does that mean any cash has gone out? Think about it. We bought a PP&E few years back. We paid out cash. That was cash outflow from investing. Now, as we're using it, we're depreciating it. Are we giving out cash every year? No, we gave it when we bought it. Investing activities. Now we're just using it. So depreciation, this is a non-cash expense. So for depreciation, your journal entry is depreciation debit and accumulated depreciation credit. And that number here is 125. Do you have any cash out here? No cash. So nothing comes to the statement of cash flows under the direct method. Next one, we're looking at interest expense. Now, interest expense is $75. Now, that would relate to the bond discount that we have on the balance sheet. Now, it says there's a decrease in bond discount of $15. Maybe we had bonds payable out here and there was an amortization of bond discount for 15. So guys, let's do the journal entries. So we're saying interest expense, that's 75. Has all of that gone out in cash? There has been a decrease in bond discount. Bond discount, that was a debit account. Decrease means you've credited it. It's got amortized. So bond discount amortization. So 75 has been the interest expense, of which $15 has been bond discount amortization and only 60 has gone out in cash. So cash plug here is 60.